Good afternoon. Thanks for coming. My name is Philip Cagnassola. I'm a general partner at Hamilton Robinson Capital Partners, and we are a buyout firm, controlled buyout firm focused on small industrial and commercial companies.
I'm Scott Reed. I'm a partner with Flag Capital Management. Our firm invests across the private capital spectrum from venture to private equity to real assets and real estate, and I lead our firm's effort in private equity.
Hi, Josh Mayfield, Director of Alternative Investments with ORIX Americas. We're a publicly traded global finance company based in Tokyo. The U.S. headquarters is in Dallas. Variety of investing opportunities from investment banking to hedge funds to principal investing in the lower middle market, and I run the alternative investment group. So mostly focused on both primary and secondary investments in PE, VC, and hedge funds.
And my name's John Madorsky. Sorry I'm late. I'm a managing principal at RCP Advisors. We're a North American small market buyout fund of funds. We have about $3.5 billion under management in secondaries, primaries, which we would be a fund of fund, and then also co-investments.
So prior to the start of this panel, I was talking with some of the panelists about how managers actually create value, and everybody seems to have a little bit of a different opinion here. We're lucky because we have a panel of LPs and GPs, so we have both perspectives here. Why don't we just start with how you actually define value and how you measure value? Phil, if you want to start from actually what you think.
Sure.
From the GP standpoint.
Sure, I'd be happy to. Briefly, I guess I know you want to talk a little bit later on about how GPs maybe add value into their portfolio companies, which I think is an important topic, but I think it's only one component of adding value if I think it from the LP's perspective. There's a lot of variables that would go in, investment pace and commitments and strategy and the like, and the team. I think it's for me, the biggest component of value is really, from an LP perspective, understanding the principles and values of the GP and making sure that what they understand, what motivates a GP into taking action, either going left or going right, and then ultimately making sure they have a very high say-do ratio in terms of how they're going to approach that. Some LPs might be motivated by IRR, some by investment pace, some by cash on cash. All those things will drive them to evaluate value, and I think you define it as how is it measured. It's ultimately, everybody's going to measure it a little differently. But I think to have somebody come in and understand what motivates a GP to take, to go left when they could go right, and make sure that if they always say they're going to go right, then it gives them a high baseline on whether they can really trust that GP once the relationship happens.
Doing what you say you're going to do.
High say-do ratio.
Yeah, I'd agree there's a lot of qualitative factors that go into assessing whether a manager can or does create value. That said, we do try to measure a value creation as an LP, and for each group that we're considering, we will do a statistical analysis and try and quantify that. And so really there are three ways that a manager can create value. It's growing cash flows, or in most cases EBITDA. It's gaining some degree of multiple expansion or perhaps multiple contraction, and then there's deleveraging or other sort of financial engineering type aspects, and we have built models to quantify that, and then we further break it down to, in the case of earnings growth, we try to isolate how much of that comes from top line or revenue growth versus margin expansion or contraction, and on the financial engineering side, right, how much is coming from deleveraging versus other types of structures, preferred vehicles and whatnot. And what we like to look for are managers for their realized transactions that have historically generated at least 50% of their realized value from earnings growth or cash flow growth, as opposed to multiple expansion or financial engineering, because that's generally more or arguably more repeatable over the course of time, whereas multiple expansion may very well depend on the market ebbs and flows.
Yeah,
Fair enough.
so I think Philip mentioned it is you have to actually define what's important to you from an LP standpoint, and then you can actually determine whether there's value creation or not. And so for many investors, that is you want to be in the very best or the top quartile or even the number one position fund, just who is going to make me the most money. And so then determining whether or not that manager is able to deliver value, it's more of a statistical analysis. But for somebody like ORIX, where we are, we're kind of a unique animal in that we're not a fund or a pension. It's a corporate balance sheet. For us, value is a manager's ability to drive other investments, whether it's a co-investment or debt opportunities. And so for us, if I said if co-investments are important to me, then I can measure a manager's ability to provide that. So one manager is more valuable in that sense to us than another. But I think step one is every investor, every GP is going to have a point that's the most important for them. And once you define that point, then you can figure out what the value measure is.
So, John, we were actually talking about this idea of value, and we were talking about whether it's, picking the right company at the beginning or, having operational expertise versus financial engineering or knowing how to exit. What is most important when you're thinking about those different pieces of the equation there?
Yeah, I think it's hard for us just to look at a single company and say how they created value, because what we're not considering is the broader market. So, if they're investing in something where every company is doing well, then have they created value, or are they just de facto stock pickers? So what we're trying to do is not just look at it in isolation, but also in larger practice. So we'll do company vintage year comps to see how their companies have performed against like-sized privately held companies, and we're tracking all this in a database. So it's not just are they creating value in isolation, but broadly, are they better than other people? Because we have the opportunity of not investing in one manager, but investing in another. So ultimately, there's a lot of ways to create value, obviously on the buy, on the hold, and on the exit. And I think we're relatively indifferent towards how they're creating value as long as it's repeatable. So that idea of repeatability is very important for us as well, because ultimately by looking at the past transactions, we don't get to invest in them, right? We have to invest in the next blind pool. So we want to see that pattern recognition that they've always done it the same way.
So, Phil, putting you a little on the spot, when you're looking at some of these companies that you're going to invest in, how important are you thinking, or how portfolio intensive do you feel like you need to be to create value? There's so much now in talk about the operational expertise here.
There's certainly a lot of talk about it, and I think it really goes down to, in many respects, to the operating model and to the philosophy of the firm. I mean, I probably a theme I'll come back to is it does go back to the core values and principles of the firm and how they're organized. So, for example, if you are a turnaround firm and you're going to take in some, and you've got a bunch of partners who were ex-operators, well, then you, by definition, your model would dictate you can be and need to be very active, hands-on into that firm. If you're more of a bunch of ex-investment bankers and that's been your how your model is formed, and you're betting growth stocks, then maybe you don't need to be as operationally active, because then you're going back to your model is more picking the winners from the losers. You're trying to bet a trend there. Our model a little bit is we invest in many respects in small companies that are bent, not broke. Our mindset is that the only thing we know for sure, and this goes back to, I think, making sure your LPs match up very well with your GPs, that's going to define the best value for you, is one of the things we truly believe at our firm is the only thing you know for certain the day you do the deal is how much money you can lose. That's the only thing you really know. And then everything else is an opportunity. But ours is to invest in industrial companies that are bent, not broke. We don't believe in having operating partners on staff. We think in these small companies, there's a whole host of the small companies we play in the middle market. The small end of the middle market, there's enough there for everybody where you can find a good company with a margin of safety that fits your profile. And we don't want operating partners sitting between us and our CEOs. We think that the dynamic is too intimate in these small companies. It's too delicate, and to put another operating partner in the middle of that would be ultimately betraying the value we're trying to bring to our partners.
Scott, or the LPs, I'm curious from your side, how do you feel about the operating partner model today when we hear so much about it?
We definitely hear a lot about it. It seems to have been the flavor of the past few years to add operating capabilities. And I wouldn't say that there's one model that we think works. Every situation is different. It depends on the manager's strategy. That being said, I think I'm less impressed when I see a list of a dozen or 15 operating partners on a GP's website, because in many instances, maybe those people are in the orbit of that GP, but they're not necessarily really adding value in a consistent way. And I like to think about it in terms of their incentives, right? Some of these operating partners, they're looking for board roles and maybe a free option. They're going to get some options in a company, and they're inclined to help see the rosier side of a prospective deal because they're going to get a board seat and maybe a call option on the success of that company. The operating models that I tend to prefer are ones where the operating partners are truly getting engaged in the diligence of a situation, and then they're being asked to put skin in the game, writing a personal check alongside the GP to demonstrate their conviction in an opportunity. And the other types of operating models that we've seen some recent success with are those GPs that bring in functional operating experts as opposed to just board advisor types. So maybe it's a specialist that only focuses on go-to-market strategies, or there's a manager of recruiting, or if it's an industrial-oriented GP, somebody who's a lean expert, or GP or operating partners of that ilk that can truly add value in a tangible way across the portfolio as opposed to just sitting on a board and offering sage advice.
John, does anybody want to answer that down there?
I was just thinking a little bit about the operating model, and I promised Danielle I would say something sort of cynical, so here we go. I'm not sure if the operating model really is functional. So if I could think back at all of the carry allocations in every fund, very rarely do we see an operating partner having as much carry as a transaction partner. When we think about the turnover of partners at private equity funds, we typically see a higher level of turnover at the operating partner over the private equity partners. And then finally, when we see the incubation or the makeup of most private equity funds, it's probably more investment banking, deal guy types versus operating partners. So if I'm just looking broadly at our landscape of private equity, I would challenge these guys and say, well, why is that the case? Do operating partners really matter? Are we really just de facto hiring outside consultant service providers that these smaller companies historically haven't had the opportunity to have?
Yeah, I think what's more important is whether it's an operator model or not. I think it's just the specialization capabilities. So I think for us, if we're currently looking for energy investment opportunities, and so if the five partners all have deep experience in the oil patch, then there's really no need to go out and also have kind of a standby portfolio of operators that they can put in there, right? Because they already have the requisite specialization. I think that's more important to us, and that's why I think we tend to focus more on funds that are specialized. Maybe not it's for a single industry, but at least it's more of a 2 or 3 industries versus kind of the guys who are kind of want to be everything to everybody. I mean, I think if you have a true generalist PE model that covers probably 10 industries, then I think it's important that they do have folks that they can parachute into these companies.
I think the other perspective is like going back to this idea of if operating partners matter, how do private equity guys create value? At the end of the day, a lot of these professionals have been in private equity for 20, 25 years. So are they themselves operators at that point? At one point, do you transition from being a person that worked in an investment bank 25 years ago to being an entrepreneur that's seen and helped companies be run over the last 25 years? So maybe that's the counterpoint to the operating partner title, if you will.
So just moving on a little bit, talking about what are some of the worst traits that you commonly see in PE managers, and somebody on the panel prior to this had actually said buying at bad valuations, and they see that toward the end of a fund's investment period. And Michael Iarlio, during his talk just right before this, actually had a slide that said, the first couple of deals are the best, and then you tend to see the last two are like the worst. So there's actually data supporting that. But can you guys just talk a little bit about if that is in fact the worst trait, or are there other traits that you are commonly seeing in GP managers?
Well, I guess I do agree that the number one way to detract value is to overpay, because it's the one part of the deal you can't change once the deal is done. That being said, there are other ways that GPs can screw up. And we've seen plenty of instances, for example, when a GP tries to consolidate an industry just for the sake of consolidation, and perhaps they're not truly integrating the assets, or they're not as complementary as they thought. So failed roll-up strategies would be one. Other instances, obviously, over-levering a company, making the management team uncomfortable operating with that degree of pressure on the balance sheet, getting too close, trying to micromanage companies. GPs will never know as much as their executives about the businesses that they run, and if they attempt to do so, they often either steer the company in the wrong direction, or at a minimum, run into conflict with their managers.
Yeah, I'm sorry I missed that slide, because when you asked for some ideas, that was one of the ideas, which is, and we don't have the hard data, but that was our theory that we talk about, is that investments towards the end tend to...
We had a slide.
I'm going to have to track that down. So, yeah, I think we've seen people try to jam in investments close to the end, and just anecdotally, they don't seem to be to do as well. And then I would also say, holding on to investments too long. And there's, I think everybody who invests in funds probably has those deals where the manager's sitting at 4x, and we would just monetize it, right? Just now. But they think they can get 6, and maybe they have a really good case for getting 6, but maybe they don't, right? And so I think that's one way. Like, it cuts both ways. If they do hold it, then great. It all works out. But we've seen plenty of managers who have wanted to hold on longer than they should, and value has gone down. So those are my two big areas of way to track value.
I would just add one more to Josh's idea, which is holding on too long, and the other is just holding on to bad companies for too long. They consume an inordinate amount of time just to get a return of capital back. Sometimes it'd be better just to sort of let them go away and focus on creating value on the really great companies. So, but that was my the holding on too long idea on both parts.
I have plenty more questions here, but I also want to open it up to the audience if anybody has any questions at this point for the panelists. Okay. Is there anything that you guys can do, or is there anything that you use to predict new funds, debut funds, emerging managers? How do you vet those opportunities? Or do you at all?
Yeah, I have a very, very small data set, so we don't typically back new managers. We have, and I think so. It would be for us in the cases where we've done it. It's because it's a specialized manager. It's a manager who only does U.S. consumer and retail, or it's a manager who only does energy services companies. And so it's not a guarantee of success. But we feel like if somebody has spent their entire career in a particular industry, then they got the best shot as anybody else. And so those are their only predictors. And I wish I had empirical data to show that those ultimately play out as good predictors. But I think that's our view.
We're on the search for that holy grail of the conditional probabilities, right? How do we identify a great manager before we have any track record? And I would say it's elusive. It's I guess good news for us that we get to keep our jobs and we don't get computerized it, but in reality, it just is very, very difficult. For us, there's attributes of first-time funds that we're always looking for because there's more risk inherent with them. So we want a team that's worked together in the past. We want a track record that's attributable, that we can really see through, again, getting that fact pattern or the persistence. And then finally, it's got to be an opportunity that we can't get elsewhere. Why do we want to take on more risk in one manager if we can just sort of buy it elsewhere with less risk? So it's a very difficult thing to identify, Danielle, but it's sort of our holy grail.
Agree, it is difficult. We actually did undertake an analysis last year to try and identify some common traits for first-time funds that either did well or did less well. And overwhelmingly, of the sample set of a couple hundred funds that we identified, first-time funds, the ones that performed most poorly, either on an absolute basis or on a relative quartile basis, were groups, perhaps unsurprisingly, that included folks who didn't have a vettable track record, a collection of investment bankers coming together, hanging out a shingle and trying PE. But also interestingly, the cohort of managers that came together from different firms and hadn't worked together. So you might get a PE guy from X, Y, and Z shops coming together to form up because they feel they have the same philosophy and want to try something on their own. And those types of situations unequivocally will bias towards less good results.
Phil, I would just ask you, do you feel like you're constantly getting different advice and opinions from all your LPs and trying to keep everybody happy? I mean, not changing your strategy, that's not the right word, but it's like a constant balancing act from you to hear, this is what we think you should do, this is what we think you should do.
Well, it's certainly, there's an aspect to herding cats, I guess, a little bit sometimes, but I think if you develop the right LP base, and it takes time. I go back. You can quantitatively analyze anything you want at a GP. Ultimately, you're making a very personal decision to invest with this group. You have to do it for the right reasons because it's going to be a long-term relationship. And if you get the right group that has enough commonality in the base, that buys into what you're doing, that believes in what you're doing, and believes that you bring a strong value proposition to the table, then you're going to have a great run with it. We've been fortunate. We've stayed small. We've maybe stayed underneath the radar in many respects, but we've had a great LP base for a long time now. That's been, for us, very supportive, and it's allowed us to ultimately execute on our strategy, to do it in a very measured, disciplined way, and ultimately, and I think, deliver great results back to our LPs that they're very happy with. And it's just. But yes, I can see you getting into that. But I also think that, one of the things that these guys talked about, best and worst traits, and I kind of wanted to keep a little bit quiet, but I think it's funny that I think the best and worst trait of a GP is probably the same trait. It's been told to me that guys in my industry are kind of type A and arrogant, and I think, there's a lot of truth to that. But I think it's also, that's the truth that's going to compel you into action. You're going to take a company that's maybe been around 40, 50, 60 years, maybe has made it through a couple world wars, and you're going to say, I'm going to do better, a lot better with that company under my ownership. That's not exactly a humble statement to make, but it's also the statement that's also going to land you in trouble because you're going to try and roll up the wrong industry. You're going to think I can get 6 times when maybe I should cash out for 4. So it's kind of that, sitting on top of that knife edge, that's kind of where you ultimately have to be. And again, I go back and say it's the principles of the GP, and it's their how long they've been together. Do they have a common thread, the values and the core values that makes them make a decision to sell, to buy, to not, and how much they've stayed in one industry and one sort of focus. That's going to give you a lot of comfort that they're going to make the right decisions and make the savvy decisions. A lot of your stock picking decisions do not come just because you say, I just got lucky. It comes because I've been in this industry. I've seen this play before. I've seen it a lot.